The recent escalation in the conflict between Israel and Iran has had varied impacts across financial markets, with stock futures experiencing slight declines as investors remain cautious. The Dow Jones Industrial Average futures fell by 0.32%, while S&P 500 and Nasdaq 100 futures dropped by 0.34% and 0.4% respectively. This market reaction coincided with a Truth Social post from President Donald Trump urging an evacuation of Tehran, which contributed to a 2% rise in West Texas Intermediate crude futures overnight. However, oil prices later declined as fears of a broader Middle East conflict receded, with Brent and West Texas Intermediate crude futures settling over 1% lower. Despite the geopolitical tensions, major U.S. indexes ended Monday with gains, supported by the decrease in oil prices. Meanwhile, gold prices surged towards a record high of $3,450 an ounce, reflecting a shift towards safe haven assets. The dollar's muted response, rising only by 0.25%, contrasts with past conflicts where it appreciated significantly more, highlighting concerns over U.S. fiscal policies and the dollar's safe haven status. The ongoing conflict has prompted Iran to seek international intervention for a ceasefire, offering nuclear negotiation flexibility. Investors are closely monitoring central bank meetings, particularly the Federal Reserve's upcoming decision on interest rates, expected to remain unchanged. Analysts note that geopolitical shocks typically lead to temporary market drawdowns, with recoveries occurring within weeks to months. Additionally, President Trump's tariff policies and their potential impact on the U.S. economy's growth cycle remain a concern. In global markets, the Nikkei index rose by 1.3% due to a weaker yen, while other Asian markets like Taipei and Jakarta saw declines. European markets, including London, Paris, and Frankfurt, experienced gains. The situation adds complexity to central banks' efforts to manage economic stability amidst trade tensions and potential inflationary pressures from energy markets.
On Tuesday, June 17, 2025, financial markets are poised for potential volatility as key U.S. economic data releases are anticipated. Central to these are the core retail sales and retail sales figures, which serve as critical indicators of consumer spending behavior and overall economic health. Core retail sales, excluding the volatile automobile sector, are forecasted to rise by 0.2%, up from the previous month's 0.1%, signaling a modest improvement in consumer expenditure. In contrast, overall retail sales are expected to decline by 0.6%, a sharp reversal from the prior month's 0.1% increase, indicating potential challenges in consumer demand. These figures are crucial as they provide insights into consumer behavior, a major driver of the U.S. economy, and could significantly influence market sentiment and investment strategies. In addition to retail data, several other economic indicators will be released, including the import and export price indexes, industrial production, and business inventories. The import price index is anticipated to decrease by 0.3%, while the export price index is expected to fall by 0.1%, reflecting potential shifts in trade dynamics and easing inflationary pressures. Industrial production is forecasted to remain flat, indicating no change in output from manufacturers, mines, and utilities, which could suggest stabilization in the industrial sector. The Atlanta Fed's GDP Now estimate remains steady at 3.8%, offering a snapshot of real GDP growth expectations. Collectively, these data points will provide a comprehensive view of the current economic landscape, impacting decisions by investors, policymakers, and businesses, and potentially influencing future Federal Reserve actions.
At the recent G7 summit, U.S. President Donald Trump reiterated his support for tariffs against Canada, despite ongoing negotiations aimed at resolving trade tensions between the two nations. Trump and Canadian Prime Minister Mark Carney met to discuss a potential trade agreement that could be finalized within the next month. However, Trump emphasized his preference for tariffs as a straightforward economic policy tool, contrasting with Carney's more complex approach to trade relations. The discussions are part of broader efforts to address pressing trade issues, including U.S. tariffs on Canadian steel, aluminum, and automotive products. Canadian officials, including Trade Minister Dominic LeBlanc and Ambassador Kirsten Hillman, expressed optimism about the progress made during the talks. Despite Trump's firm stance on tariffs, both sides are working to develop a mutually beneficial economic and security relationship, with further meetings planned to refine the details of a potential agreement. The outcome of these negotiations could significantly impact bilateral trade, potentially lifting tariffs that have affected Canadian exports and influencing market sentiment. The Canadian government has refrained from escalating counter-tariffs but remains prepared to retaliate if necessary, highlighting the delicate balance in achieving a resolution.
ON Semiconductor, a prominent player in the semiconductor industry, has been the focus of recent analyst evaluations, reflecting a mixed sentiment regarding its future performance. Over the past 3 months, 13 financial analysts have provided their assessments, resulting in an average 12-month price target of $47.92, down from a previous target of $55.46. This decline of 13.6% suggests a shift in market expectations amid the company's current challenges. ON Semiconductor, known for its power semiconductors and sensors, is undergoing a strategic pivot towards emerging sectors such as electric vehicles and renewable energy, which could potentially drive future growth. Despite its strategic initiatives, ON Semiconductor faces notable financial hurdles. The company reported a significant revenue decline of approximately 22.39% as of March 31, 2025, underperforming relative to its industry peers in the information technology sector. Additionally, the company's financial health indicators, such as a net margin of -33.62% and a return on equity of -5.78%, fall below industry standards, highlighting struggles in profitability and capital efficiency. Furthermore, a higher-than-average debt-to-equity ratio of 0.42 raises concerns about the company's reliance on borrowed funds, posing potential risks to its financial stability. These factors collectively underscore the need for ON Semiconductor to address its operational and financial challenges to capitalize on its strategic market shifts.
The recent McKinsey & Company report highlights a growing misalignment between chief executive officers, CEOs, and chief marketing officers, CMOs, with a 20% increase in discord from 2023 to 2025. This divergence stems from unclear CMO responsibilities and a disconnect between marketing efforts and company growth metrics. The study, conducted in collaboration with the Association of National Advertisers, ANA, surveyed over 100 C-suite executives, including 75 CEOs and CMOs from Fortune 1000 companies across various regions. The report underscores a decline in the perception that marketing roles are well defined and understood within the C-suite, dropping from 90% to 70%. The misalignment is further exacerbated by differing priorities in performance metrics. While 70% of CEOs evaluate marketing's impact through revenue growth and margins, only 35% of CMOs prioritize these metrics. This gap in understanding and expectations has led to underfunded marketing departments, with a significant portion of CEOs and CMOs expressing dissatisfaction with their budgets. The report suggests that for marketing to contribute effectively to business growth, CMOs must align more closely with strategic and financial objectives, reinforcing the need for marketing to be integrated into core business strategies to enhance investor value and customer centricity.
Nationwide Building Society has proposed a new bonus plan that could increase CEO Debbie Crosby's maximum pay package to nearly £7 million, up from the previous cap of £4.8 million. This 43% increase in potential remuneration comes in the wake of Nationwide's £2.9 billion acquisition of Virgin Money, and is positioned as a necessary adjustment to stay competitive with major UK banks like Lloyds Banking Group and NatWest. These banks have significantly raised executive pay following the removal of the UK banker bonus cap, which previously restricted bonuses to twice the salary. Nationwide aims to offer Crosby an annual bonus worth up to 150% of her £1.1 million salary, compared to the prior 100%, to bridge the competitive gap in attracting senior talent. The proposal has drawn criticism, particularly from the High Pay Center, which argues that a member-owned building society like Nationwide should not emulate the pay practices of major banks, especially given its branding as an ethical alternative. Critics suggest that such high executive payouts contradict the values that Nationwide projects in its marketing campaigns. Despite the backlash, Nationwide emphasizes its need to attract and retain top talent to maintain its position as a leading provider of mortgages and retail deposits, highlighting its strong customer satisfaction ratings. The proposed pay policy will be voted on by Nationwide's customers in an online meeting scheduled for July 25th.
Roku Inc. has announced a strategic partnership with Amazon.com Inc., allowing advertisers to access Roku's advertising inventory through Amazon's demand-side platform, DSP. This collaboration is expected to enhance advertisers' targeting capabilities by providing comprehensive platform-level data, a step up from Roku's existing integration with The Trade Desk, which offers more limited visibility. Analysts, including J.P. Morgan's Corey A. Carpenter, have responded positively, maintaining an overweight rating on Roku. The partnership is anticipated to gradually ramp up revenue, with some impact expected in the fourth quarter, although it was not factored into Roku's 2025 financial outlook. The partnership signifies a deeper integration with Amazon, offering advertisers better insights by matching data sets from major players like Comcast and Disney, while the exclusivity of the Amazon partnership at the platform level is noted. Roku retains the flexibility to engage in additional DSP partnerships at the Roku level, potentially with companies like Google. This strategic move has positively influenced Roku's stock, which saw an 8.04% increase to $80.39. The collaboration is part of a broader strategy to boost revenue and market confidence, although explicit revenue figures from the partnership remain unspecified in the company's long-term outlook.
Shares of Oklo surged by 5.7% today, continuing a positive trend following a significant announcement last week. Oklo, a company specializing in advanced small nuclear reactors, SMRs, has been conditionally selected to supply power to a U.S. Air Force base in Alaska. This contract, pending finalization, marks a milestone for Oklo as it aims to provide the base's energy needs through its Aurora powerhouse, an SMR capable of ensuring the base's energy independence from the grid. The broader market, with the S&P 500 and Nasdaq Composite both rising, also supports Oklo's upward momentum. The nuclear energy sector has received a boost from recent policy endorsements, notably from former President Donald Trump, who signed executive orders to expedite reactor permitting and enhance domestic uranium production. This governmental support underscores nuclear energy's potential role in meeting the increasing energy demands of sectors like artificial intelligence data centers. Oklo's SMRs are particularly well suited to such applications due to their adaptability to specific site requirements. While the success of new technologies is never guaranteed, Oklo's strategic positioning and recent developments suggest a promising outlook for the company.
Digital assets are demonstrating notable resilience amid global geopolitical tensions, as evidenced by $1.9 billion in net inflows for the week ending June 14th, according to CoinShares. This brings the year-to-date inflows to a record $13.2 billion. Bitcoin and Ethereum are at the forefront of this trend, with Bitcoin capturing $1.3 billion and Ethereum $583 million in inflows, marking Ethereum's strongest week since February. The U.S. dominated the inflow landscape, contributing the entire $1.9 billion, while other countries like Switzerland, Germany, and Canada posted modest inflows. Conversely, Hong Kong and Brazil experienced net outflows, indicating regional disparities in digital asset investment. Institutional and retail investors are showing continued confidence in digital assets, which appear to be decoupling from traditional risk-off behaviors typically seen during geopolitical uncertainties. This influx precedes significant macroeconomic announcements, including the Federal Reserve's interest rate decision and jobless claims data. Additionally, the potential passage of the Genius Act in the U.S. could catalyze the adoption of stablecoins by enabling corporations to issue digital dollars, a development closely watched by retail giants Walmart and Amazon. This legislative shift could significantly enhance the utility of cryptocurrencies, particularly stablecoins, in the digital payments landscape.
The ongoing Iran-Israel conflict is emerging as a potential disruptor for Bangladesh's ready-made garment (RMG) sector, as highlighted by the Bangladesh Garment Manufacturers and Exporters Association (BGMEA). Mahmoud Hassan Khan Babu, the newly elected president of BGMEA, warned that the tensions could lead to a rise in global oil prices, thereby increasing operational expenses for the RMG industry, which is a cornerstone of Bangladesh's export economy. The conflict adds to existing challenges, such as U.S. tariffs, India's suspension of transshipment facilities, high inflation, and rising energy costs, all of which are pressuring the sector. Babu's leadership, under the Forum Panel, which won the majority of director positions in the recent BGMEA election, is committed to addressing these challenges. The panel aims to advocate for the establishment of a dedicated ministry for the garment sector, support SMEs, and manage the implications of Bangladesh's graduation from the least developed country, LDC status. Additionally, plans to introduce a digital platform for BGMEA services and reduce service costs by 25% are underway. These initiatives are part of a broader strategy to bolster the resilience and reputation of Bangladesh's garment industry amid global and regional uncertainties.